comprises informal lenders. This sector comprises informal lenders like money lenders, chit fund, and self-help groups. Unorganized sector comprises informal lenders like money lenders, chit fund, and self-help group. It plays a significant role in meeting the credit needs of large section of the population, particularly in rural area. However, the unorganized sector is often characterized by high interest rates and limited access to regulations. In human capital, on the other hand, includes skills, training, educations, etc., which improve the productivity of individual, especially labor. Normally, physical capital, human capitals are there. Physical capital like machines, tool, infrastructure, raw material. Human capitals are people, skills, training, educations, etc. Normally, Indian financial systems divided into two: organized sector, unorganized sector. Organized sector regulated by Reserve Bank of India, Securities Exchange Board of SEBI, and IRDAI. Unorganized sector, there is an informal lender, informal group. Okay, example like a money lender, chit fund, self-help group, etc. Savings and investments are two core components of capital formations. Savings, in the simplest sense, means the part of income that is not consumed. When savings is used in such a manner that is give a return in future, it becomes an investment. For example, you save a certain proportion of your income and bought a piece of land. So buying land is an investment, because if you sell it, then the sale price of the land will be higher than your purchase price, and the margin between the two will be the profit. Now, instead of selling that land, you constructed a building on that land, and then you gave it on rent. So this rent will be an extra income for you, and it will add to a current level of income or profit. So when savings are properly channelized, it increases the stock of income or capital. As savings is important for an individual, it is of prominent important for an economy. A higher level of savings lead to more investment and capital formation, which is turned become the source of economic growth. So it is the creation of savings, mobilization of savings, and conversion of savings into capital asset that leads to capital formations. The creation of savings, mobilization of savings, and conversion of savings into capital asset that leads to capital formation. There are a large number of factors that affect the rate of capital formation. There are a large number of factors that affect the large rate of capital formation in the countries, like income level of people, institutional factors like availability, numbers and coverage of financial institution, the monetary and fiscal policy of country, prevailing rate of interest, population, size of the market, etc. The large factors that affect the rate of capital formation in the country, like income level of people, institutional factors like availability and numbers and policy of the country, prevailing coverage of financial institutions, the monetary and fiscal rate of interest, population, size of the market, etc. Next, we move on to financial system. A financial system consists of a set of institutions, instruments, and market which bring the brings the savers and the investors to a common platform and provide the means by which savings are translated into investment. The principal objective of the financial system or financial market is to channelize the savings into the most productive opportunities or avenue. Financial system consists of a set of institutions, instrument and market which bring the savers and the investors to a common platform and provide the means by which the savings are translated into investment. The major objective of financial system or financial market is to channelize the savings into most productive opportunities or avenues. In financial market, there are two players, namely lenders and borrowers. Individual households generate savings and have surplus fund. They can either put this amount of money in its bag and hide it. So keep it under lock and key was done in Esther's years. This form of savings did not yield any return, and the constant fear of theft always upon the savers. On the other hand, capitalized or entrepreneur would not undertake new project of production or expand the existing production capacity of the plant due to the dearth of capital. The major role of financial system of the financial market is to bring these two together. Those who savings savers or lender put fund into bank or other financial institution, and those in need of money or finance take the money from these financial institution. In this interaction, both the lenders and borrowers gain the ultimately due to increase of production and exchange, the whole economy get benefited. The the working of financial market can be understood by lender or individual household gives financial system to borrower. Normally, the major functions of financial markets are: first one, to connect borrower and lenders of fund and to lead to process of price discovery or determination. Major functions of financial markets are to connect borrower and lenders of fund and to lead to the process of price discovery or determination. Second one, to provide liquidity in the system by allocation of fund in an efficient manner. Third one, easy access of fund to borrower, which in turn reduce the cost of the transaction. Fourth one, provide a way for managing uncertainty and controlling risk. These are the major functions of financial market: to connect borrower and lender, to provide liquidity in the system by allocation of fund in efficient manner, easy access of fund to the borrower, which in turn reduce the cost of transaction, then provide a way for managing uncertainty and controlling risk. Then components or structure of financial market. Structure of financial market or components of financial markets divided into two: money market, capital market. First money market, another one capital market. Both are essential for economic development of country. Money market, another one capital market. Indian financial system have two main components: money market and capital market, and they both are essential for the economic development of country. The money market is a market for short-term financial asset and assets which are close substitute of money. Short-term implies a time period of less than 1 year. The financial asset that can be converted into money within minimum or no transaction cost and without loss in value. The financial asset can be converted to money within minimum or no transaction cost. Another one, the major participants in the money market are scheduled commercial bank cooperative bank, and primary dealers. The money market, the major participants in the markets are scheduled commercial bank, excluding a regional rural bank, then corporate banks excluding land development bank and primary dealers. Then objectives or functions of money market. The broad objectives or functions of money markets are to provide equilibrating mechanism between short-term surplus and deficiencies. To provide equilibrating mechanism between short-term surplus and deficiency, maintaining liquidity in the system, providing access to short-term fund to the borrower at minimum or realistic cost, providing access to short-term fund to the borrower at minimum or realistic cost, to enable the central bank of the country intervention to influence and regulate liquidity in the economy. These are the major objectives of the money market. Then what are the instruments of the money markets are? What are the main instruments traded in the money market and submarkets are: first one, called market or notice market; second one, commercial paper market; third one, treasury bill or T-bill market; fourth one, commercial bill market; fifth one, certificate of deposit market; sixth one, money market mutual fund, MMFS, money market mutual fund. Instrument of the money market. Instruments of the money markets are called market or notice market; second one, commercial paper market; third one, treasury bill or T-bill market; fourth one, commercial bill market; next one, certificate of deposit market; money market mutual fund. These are the instruments. First, we discussed about call market or notice market. It is a market for short-term financial funds that are payable immediately and in full when the lender demands them. It is for the reason that call money is also known as money at call. Called money is also known as money at call. The maturity period varies from 1 day to a fortnight. That means 14 days. When the fund or borrowed or lent for a day, it is called overnight money. If the duration of fund borrowed or lent is more than a day and up to 14 days, it is called noticed market. Okay. The duration of fund borrowed or lent is more than a day and up to 14 days, it is called noticed market. For conducting transaction in the call or notice market, there is no need for any collateral security. The major player in the call markets are bank and primary dealers. The interest rate payable on call loan is known as the call rate. The interest rate payable on the call loan is known as the call rate. The call market. Second one, commercial paper market. Commercial papers market. Commercial papers are short-term unsecured instruments issued by companies to raise short-term debt. They are issued in the form of promissory note and in India they were introduced in 1990. Large corporations, primary dealers and financial institutions are authorized to issue commercial papers. Normally, primary dealers and financial institutions are authorized to issue commercial papers. The maturity duration of commercial paper is a minimum of 7 days and a maximum of up to 1 year from the date of issue. The duration of commercial paper is minimum 7 days and maximum of up to 1 year. The date of issue. They are typically issued to short-term financial obligations like funding of the new project. They can be issued in denominations of rupees 5 lakhs or multiplies thereof. Furthermore, eligible participants need to obtain a credit rating for the insurance of commercial papers. They need to have minimum credit rate as per the Securities and Exchange Board of India. Minimum credit rate as per the SEBI definition rating symbol. Commercial papers are issued a discount to face value basis. They have many advantages like the options, diversifications for the sources of finance, higher return and liquidity. Commercial paper, then treasury bill. Next one, treasury bill or e-bill. Treasury bill or e-bill are short-term debt obligations issued by Indian government to meet its short-term funding needs. They are considered one of the safest investment option in India because they are backed by government guarantee. Some breakdown of bills are treasury bill or T-bill or short-term obligations issued by Indian government to meet its short-term financial needs. It's a guaranteed one because the government issued treasury bill. Okay. The treasury bill are short-term borrowing instruments by government of India. There are kind of promissory note issued by Reserve Bank of India. The government uses treasury bill to arise a short-term fund to bridge the temporary or seasonal gap when a deficit arises due to shortfall or situations when receipt fall short of expenditure. The insurance issued by the government of India. A maturity T-bill or short-term instrument with maturities ranging from 91 days. That means 3 months to 364 days, 1 year. The ranging from 3 months to 1 year. The interest, unlike traditional bond, treasury bill don't pay regular interest. Instead, they are issued at a discount to their face value and redeemed as per maturity. The profit is the difference between the purchase price and the maturity value. The profit, your profit is the difference between the purchase price and the maturity value. Example, let's say you buy a 10,000 rupees treasury bill at a discount of 100. Purchase price is 9,900. At the maturity, you will receive 10,000. Your profit is rupees 100. Okay. By a 10,000, treasury bill has a discount of 100. Purchase price 99,000, 99,000. 9,900. At the maturity, you will receive 10,000. Your profit here is 100. Okay, then benefits. Benefits of treasury bill. First one, safe investment. Very safe investment backed by the government. Treasury bill are considered highly secure. Second one, a low risk. Interest rate are determined by market force, but due to their short tenure, they are generally less volatile than long-term bond. The third one, high liquidity. Treasury bill can be sold in the secondary market before maturity. Treasury bill can be sold in the secondary market before maturity if needed. Then treasury bill is a short-term borrowing instrument by government of India. These are a form of bill that does not arise from any genuine transaction in goods. They are kind of promissory note issued by Reserve Bank of India. The government uses treasury bill to raise a short-term fund to bridge the temporary or seasonal gap. The net short-term market borrowing of the government through 91 days, 180 days, and 364 days. Treasury bill stood at rupees 37,528 crores during 2019 to 20. Treasury bill stood at rupees 37,528 crores during 2019 and 20 period. Next, move on to commercial bill market. Commercial bill include bill of exchange and promissory note. A promissory note is a form of financial instrument in which the note issuer and the note payee undertake a written promise whereby the issuer promise to pay a definite sum of money either on demand at the specified future date to a particular person or bearer of the instrument. The commercial bill originates due to original trade transaction. There are many types of bill like trade bill, commercial bill, inland bill, foreign bill, indigenous bill, and etc. Rediscounting bill is an important segment of bill market. Commercial bank often make use of such facilities. Let us understand the concept of rediscounting with the help of an example. Suppose a commercial bank buy 91 days treasury bill at rupees 10,000 and receive rupees 11,000. At the time of maturity, in this case, the difference between purchase price and face value of the bill is rupees 1,000 is called discount. Rediscounting occurs when the short-term negotiable debt instrument is discounted for a second time. In continuation with the above example, let's assume that the same bank need money urgently for say 30 days. It will approach the central bank of the country and central bank can purchase the same bill from the bank say for 10,050 for the period of next 30 days. But before 90 days, the date of maturity, this case, the re-discount or difference between purchase price and the face value is rupees 50. Next one is certificate of deposit market. Certificate of deposit market. Certificate of deposits are negotiable money market instrument against funds deposited in a bank or other financial institution for a fixed time period at a specific rate of interest. It's a negotiable money market instrument against fund deposit in a bank or other financial institution for a fixed time period at a specific rate of interest. The scheduled commercial bank, except RRBs and local area bank, and selected all India financial institution can issue certificate of deposit. Okay, certificate of deposit marks in a minimum amount of rupees 1 lakh and in the multiplies of rupees 1 lakh. The maturity period of certificate of deposit market is minimum of 7 days and maximum up to 1 year. The duration or maturity period of commercial certificate of deposit is minimum of 7 days, maximum of 1 year. The cash reserve ratio and stationary liquid ratios or issue price of certificate of deposit. Next one, money market mutual fund. Money market mutual fund to increase the participation of individual and small investors in the money market and to provide additional short-term fund avenues to the investors. Money market mutual funds are introduced in April 1991, and the detailed scheme of money market mutual fund was announced by Reserve Bank of India in 1992. A mutual fund is an investment scheme mostly run by asset management company. Money is collected from a number of investors, and this pool of money is invested in stock, bond, and other securities. Money market mutual fund are mostly benefited for small investors like a salaried class who park their fund in money market mutual fund and have gained better return. They offer a diversification of short-term assets in terms of issues, maturity and volume, thereby spending the risk. Whenever investors buy mutual fund, they are allotted unit share of the mutual fund. These mutual funds are professionally managed, and investors earn income in the proportions to the number of units owned by them. Initially, only bank, financial institutions, and their subsidiaries were allowed to set up money market mutual funds, but our corporates and other were allowed for the same from 1996. All the money market mutual funds are governed and regulated by Securities Exchange Board of India. All money market mutual funds are governed and regulated by Securities Exchange Board of India. Then structure of money market. Structure of money market. The money market is again divided into two: organized, unorganized. Money market is divided into two: organized, unorganized. Organized money market. Organized money market is again divided into two: RBI, Reserve Bank of India, commercial bank. Reserve Bank of India, commercial bank. Unorganized sector. Unorganized money markets divided into indigenous bank, non-banking companies, money lenders. Unorganized money market again divided into three. Unorganized money market again divided into three: indigenous bank, non-banking companies, money lenders. Indigenous bank, non-banking companies, money lenders. The organized sector consists of Central Bank of India or Reserve Bank of India, commercial bank, both nationalized and private. And foreign banks, cooperative banks, the discount and finance houses of India, and other financial institutions like IFCA, ICICI, LIC, GCI, and mutual funds are also operate in the money market. The unorganized sector consists of non-bank financial intermediaries, indigenous bank, and money lenders. Then banking structure. Banking structure in India. According to the Banking Regulation Act 1949, a banking company is a company that transacts the business of banking in India, and banking means accepting deposit of money from the public for the purpose of lending or investment. However, with the promise of repayment on the demand by the depositor, with the facilities of withdrawal by check, draft, order, or otherwise. The functions of bank have changed from traditional to many more functions like collection and payment of check, bills and promissory notes, sale and purchase of securities, remittance of fund, merchant banking, services of automated teller machines, electronic fund transfer system, dealing in foreign exchange as others. Normally, the functions of bank can be changed from traditional accepting deposit and lending credit. But nowadays, too many more functions like collection and payment of check, bill of promissory note, sale and purchase of securities, remittance of fund, merchant banking, services of automated teller machines, electronic fund transfer system, dealing in foreign exchange and other things. Normally, Reserve Bank of India divided into scheduled bank in India. Scheduled banks in India is divided into two: scheduled commercial bank, scheduled cooperative bank. Scheduled bank in India divided into two: scheduled commercial bank, scheduled cooperative bank. Scheduled commercial bank again further divided into two: public sector bank, private sector bank. Scheduled commercial bank divided into public sector bank, private sector bank. Then scheduled cooperative banks again divided into foreign bank, regional, rural bank. Scheduled cooperative bank divided into foreign bank, regional, rural bank. Then public sector bank again classified into nationalized bank, State Bank of India and its associate. Nationalized bank, second on State Bank of India. Public sector bank again divided into nationalized bank, State Bank of and its associate. Then private bank divided into two: old private bank, new private sector bank. Old private sector bank, new private sector bank. There is our Reserve Bank of India, which is regulator of banking sector and supervise the monetary policy of the country. After that, we have scheduled bank that are further classified: the scheduled commercial bank and scheduled cooperative bank, public sector bank, private sector bank, foreign bank, and regional rural bank. Within the public sector, there are nationalized bank and the State Bank of India and its associate. Private sector bank have two categories: old and new private sector bank, in the following sections. First, next one, discuss about Reserve Bank of India. Reserve Bank of India is an apex bank of country and acts as the regulator of the financial and monetary system in India. Reserve Bank of India is a regulator of financial and monetary system in the country. It was established after the recommendation of the Hilton-Young Commission. It was established after the recommendation of Hilton-Young Commissions. It was established as a banker to the central government by the Reserve Bank of India Act 1934, and it begins its operations from April 1935 as a private shareholders bank with a paid up capital of 5 crores, and in 1949 Reserve Bank of India was nationalized one. Major functions of Reserve Bank of India is: one is note issuing authority. Second one, bankers to the bank. Third one, bankers of the government and debt manager. Bankers of the government and debt manager. Fourth one, banking sector regulator. Fifth one, foreign exchange manager. Next one, maintaining financial stability. Then development role. Last one, a regulator of the monetary policy. These are the major functions of Reserve Bank of India. First one, note issuing authority, bankers to the bank, bankers of the government and debt manager, banking sector regulation, foreign exchange manager, maintaining financial stability, development role, then regulator of the monetary policy. First one, note issuing authority. Note issuing authority. Reserve Bank of India has the monopoly over note issuing in India, other than 1 rupee note, sorry, 1 rupee coin and coins of smaller denomination. RBI ensure that most currency notes and coins are available in adequate amount in the country. The currency note issued by Reserve Bank of India and legal tenders in the length and breadth of the country. RBI can ensure currency note up to the determination of 10,000 to a present note in the denomination of rupees 5, 10, 20, 15, 100, 200 and 500 or issued. Similarly, coins circulation 1 rupee, 2 rupee, 5 rupee, 10 rupee, 20 rupee, etc. The note issuing authority of Reserve Bank of India. Second one, bankers to the banker. All the banks in a country have account in the Reserve Bank of India, which bank settled interbank transaction and customer transaction. It is also enabled bank in the maintaining statutory reserve requirements like SLR and act as lender of the least resort. It also provides short-term loan and advance to bankers and when need arise. Then bankers of the government and debt manager. Bankers of the government and debt manager. Reserve Bank of India act a banker to the central government. Reserve Bank of India act a banker to the central government of the country, along with those state government which have agreed with Reserve Bank of India. It maintains the government accounts and financial transaction with the transfer of government bond. The bankers of the government and debt manager maintain the government account and financial transaction with the transfer of government fund. It manages the government domestic debt and raises the money both from the public and financial market to bridge the shortcoming of revenues. It manages the government domestic debt and raises the money both from the public and financial market to bridge the shortcoming revenues. Then banking sector regulator, Reserve Bank of India regulate and supervise the banking system of the country. It accordance with the various provisions of Reserve Bank of India Act and Banking Regulation Act. Reserve Bank of India as a regulator does not wide range of activities like providing licensing, prescribing capital investment like capital adequacy form, paid up capital and lending to priority sector of the economy like farmers, women, etc. Regulation of interest rate and inspection of the bank and bank branches, setting of different regulatory norms and also initiate new regulations in accordance to the changing circumstance. Foreign exchange, next one, foreign exchange manager. As you may have read that trade is very essential for any economy. For conducting trade, adequate stock of foreign exchanges reserve are an important requirement. Reserve Bank of India play an important role in banks with both the development and regulation of foreign exchange market. It regulates the transaction which are regulated and exchange market. It is an custodian of foreign exchange reserve and the gold reserve of country. The bank and selective instrument which wish to deal in the foreign exchange need to have a license from Reserve Bank of India. Next, we move on to a development role. Development role. Reserve Bank of India aim at promoting financial literacy and education among the public and also ensure that credit is available to the productive sector of. For the development of Reserve Bank of India has established many institutions like National Bank for Reconstruction and Rural Development, NABARD, National Bank for Reconstruction and Relocation. For development purpose, Reserve Bank of India has established many institutions like Reconstruction Unit Trust of India, Deposit Insurance and Credit Guarantee, Industrial Development, everything, etc., etc. Development role. Next one, regulator of monetary policy. Monetary policy is the policy of Reserve Bank of India through which is regulate the financial market of the country, and most importantly, it is used for credit control. Monetary policy is the policy of Reserve Bank of India through which is regulate that financial market of the country, and most importantly, it is used for credit control. Next one, a regulator of monetary policy. Regulator of monetary policy. Regulator of monetary policy is the policy of Reserve Bank of India through which is regulate the financial market of the country, and the most of importantly it is used to credit control. Credit created is one of the SIT function leads to bank before moving towards the customer. Next one, methods adopted by Reserve Bank of India for credit control. What are the methods are adopted by Reserve Bank of India for credit control? First one, qualitative method. First one, quantitative method. Second one, qualitative method. Quantitative method, qualitative method. Quantitative methods are used to control total quantity, or volume and the cost of the credit created by bank. Within qualitative method, we have direct and indirect instruments. The qualitative methods are used to control total quantity or volume and the cost of credit created by bank. Then the quantitative methods divided into two: direct instruments, indirect instruments. The direct instruments are, one is cash reserve ratio. Cash reserve ratio. Cash reserve ratio, it is the minimum amount of their net demand and time liabilities. The cash reserve ratio percentage is notified from time to time by Reserve Bank of India. Cash reserve ratio ensure that bank have sufficient cash for their depositor requirement. Okay, so cash reserve ratio is a direct instrument to measure the total quality It's a cash reserve ratio means it's a minimum amount that bank keep with Reserve Bank of India as a proportion of their net demand and time liabilities. Cash reserve ratio percentage is notified from time to time by Reserve Bank of India. Cash reserve ratio ensure that bank have sufficient cash for their depositor requirement. Second one, statutory liquidity ratio. Statutory liquidity ratio. It is the percentage of net demand and time liabilities that bank have to monetary maintained in safe and liquid asset like cash, gold, or government securities. So it is the percentage of net demand and time liabilities that bank have to mandatory maintain its safe and liquid asset like cash, gold, or government securities. Statutory liquidity ratio restrict the expansion of bank credit, increase bank participation in the securities market, especially government securities, and it is also ensure the solvency of bank. Third one, refinance facilities. Refinance facilities. This facility is used by Reserve Bank of India to provide adequate credit to selective sector like the export sector. Refinance facilities. This facility is used by Reserve Bank of India to provide adequate credit to selective sectors like the export sector. Second one, indirect instrument. Now, quantitative methods divided into direct method, indirect method. Direct methods are cash reserve ratio, statutory liquidity ratio, refinance facilities. Second on indirect instruments. First one, bank rate, repo rate, and reverse repo rate. Second one, liquidity adjustment facilities. Third one, open market operations. Fourth one, market stabilization scheme, and marginal standing facilities. First one, banking rate policy. According to Reserve Bank of India Act 1934, the bank rate, the standard rate at which Reserve Bank of India is prepared to buy or read discount bill of exchange or other commercial papers eligible for purchase under this act. The bank rate has been aligned to the marginal standing facilities and it changes automatically when marginal security factors changes. Second on repo rate. Repo rate. It is the rate which Reserve Bank of India lend to the bank overnight against the collateral of government and other approved securities under the arrangements of liquidity adjustment facilities. Interest rate at which bank borrow from Reserve Bank of India for the last short term at the present monetary policy committees decide this policy rate along with reverse repo rate. Reverse repo rate is the kind interest rate that which Reserve Bank of India borrow from bank in order to absorb liquidity for the short term. Reserve Bank of India borrow against the collateral of eligible government securities under this factor, under liquidity adjustment facilities. These facilities, liquidity adjustment facilities, was introduced by Reserve Bank of India after it was suggested by Narasimham Committee on banking sector reforms 1998. It is the mechanism for managing the liquidity needs of banks. It aimed to absorb liquidity from the system in the situation of shortage of and excess. The repo, reverse repo, and temperature repo, overnight variable rate repo actions. Overnight variables rate, reverse repo, or components of LIF. Then open market operations. Third one, indirect instruments. First one, bank rate. Second one, liquidity adjustment facilities. Third one, work per market operations. It refers to the buying and selling of government securities by Reserve Bank of India in the money market. Both the purchase and sales of the security may lead to expansion and contraction of the money. For example, at the time of inflation, the Reserve Bank of India sell these securities and bank buy them. When bank buy these securities, then bank credit is directly away from the public to Reserve Bank of India, which leads to less credit creation and less supply money in market. Next one, market stabilization scheme. Market stabilization scheme. In this scheme introduced in 2004, withdraw excess liquidity from the market by selling government bond. The problem of excess liquidity was due to Reserve Bank of India purchase of foreign currency. Next one, marginal standing facilities. Marginal standing facilities is a facility for banks that can be used in an emergency. Under these facilities, a scheduled commercial bank can borrow up to 1 year. The 1% of their 100 basis point more than the repo rate for the short term from Reserve Bank of India. It provides safe value to banks against unanticipated liquidity short. These are the qualitative methods. Qualitative methods are divided into two. Direct qualitative method means used to control total quantity or volume that cost of credit created by bank. It's divided into two. Direct instrument. Direct instruments are cash reserve ratio, statutory liquidity ratio, refinance facilities. Indirect instruments are bank rate, repo and reverse repo rate, liquidity adjustment facilities, open market operations, market stabilization scheme, and marginal standing facilities. Next one, qualitative method. Qualitative method, this method is focused on certain sector only. By using this method, Reserve Bank of India can divert the flow of credit from one sector to another sector. The different quantitative methods used by Reserve Bank of India are credit rating, credit rationing, consumer credit regulations, increasing margin requirement, moral suasion, direct action, and others. These are the qualitative methods used by Reserve Bank of India. First one, credit rationing. Under this method, Reserve Bank of India control and regulate the purpose for which credit is granted by bank. The central bank can put a ceiling on the amount of loan that can be advanced to the bank. Second one, consumer credit regulation. This method help in controlling excess spending by the consumers. Reserve Bank of India can direct bank to fix minimum percentage of down payment, installment amount, loan duration, etc. Minimum percentage of down payment, installment amount, loan duration, etc. Next one, margin requirements. Margin requirements is the difference between the market value of the security which is pledged for taking a loan and the maximum amount of loan which can be disposed against the security. Then moral suasions. Reserve Bank of India request commercial bank to behave in a particular manner according to the financial situations of the economy. For example, during inflation, Reserve Bank of India requests commercial bank to restrict bank advance. It is a sort of advance and there is no compulsion by Reserve Bank of India. The effectiveness of this policy depends upon coordination between Reserve Bank of India and commercial bank. Then direct action, it refers to the direction and the control which Reserve Bank of India enforces the particular or all bank in case of default to adverse of Reserve Bank of India. Reserve Bank of India can reject the request of bank for the grant or rediscounting facilities. Next one, scheduled banks in India. Scheduled bank in India. Scheduled banks are those banks that are included in the second schedule of the Reserve Bank of India Act 1934. These banks needed to have paid up capital and reserves of not less than rupees 5 lakhs. These also need to maintain balance of Reserve Bank of India. They can raise debt and loan from Reserve Bank of India at the back rate. Scheduled commercial bank or further classified as public sector bank, State Bank of India, private sector bank, State Bank of India and its associate private sector bank, old and new private sector bank and foreign bank. Scheduled commercial banks are classified into public sector bank, State Bank of India, private sector bank and foreign bank. First one, public sector bank. Public sector's bank or those banks in which more than 50% of shares are held by more than 50%. These are the major type of bank in India. At present, in 2021, there are 12 public sector banks. 12 public sector banks are there in India, namely State Bank of India, Bank of Baroda, Bank of India, Punjab National Bank, Indian Overseas Bank, Punjab and Sindh Bank, Indian Bank, UCO Bank, Bank of Maharashtra, Central Bank of India, Canara Bank, Union Bank of India. These are the 12 public sectors bank. Okay, next one, SBI. SBI is the biggest commercial bank in the country with nearly 25% market share and has over 22,000 branches and 58,500 ATMs. SBI came into being on 1st July 1955 when they collapsed the State Bank of India Act 1955 by taking over the asset and liabilities of the Imperial Bank of India. Imperial Bank of India was formed in 1921 through the amalgamation of three presidency banks, namely Bank of Madras, Bank of Bombay, and Bank of Bengal. At present, SBI is a Fortune 500 company and headquarters in Mumbai. SBI had 7 associates, namely State Bank of Bihar, Jaipur, Hyderabad, Indore, Mysore, Patiala, Saurashtra, Travancore. However, in 2008 and 9, State Bank of Saurashtra and Indore was merged with SBI, and remaining association, State Bank of Jaipur, Hyderabad, Indore, Mysore, Patiala, and Travancore, merged in 2017. Now it's called SBI, State Bank of India. Next on private sector bank. Private sector banks are those banks in which the majority of the stake is owned by private shareholders. The majority of the stake is owned by private shareholders. In India, private sector banks are classified as old and new private bank. The private banks which are not nationalized in the year 1969 are collectively known as the old private bank, and it include the Jammu and Kashmir Bank Limited, Lord Krishna Bank Limited, etc. As of April 2021, the number of private sector bank in India was 22. As in April 2001, the number of private sector bank in India was 22. Some of the famous private sector banks are ICICI, HDFC, Muthoot Fincorp, etc. Next one, foreign bank. Foreign bank. Foreign banks are those banks which have headquarters in a different country but has branches in India. As of July 14, 2020, there are 46 foreign banks in India. 46 foreign banks in India. These banks have to follow rules both of home and host country. Example, bank of some foreign banks are Bank of America, Bank of Ceylon, National Australia Bank, BNB Boss, etc. Some foreign banks in India. Next one, regional rural banks. Regional rural banks were established in 1975 to develop the rural economy and creation of additional channel to corporate credit structure to enhance the reach of institutional credit for rural and agriculture sector. There are 43 regional rural banks are there in India. 43 regional rural banks as of April 2021. Next one, scheduled cooperative banks. Cooperative banks functions on the concept cooperative credit society, wherein the member of the society join together to extend a loan to each other at a subsidized rate of interest. Scheduled cooperative banks are two types: scheduled state cooperative bank and scheduled urban cooperative banks. There are 23 scheduled state cooperative banks and 53 scheduled urban cooperative banks in India. There are 23 scheduled state cooperative banks and 53 scheduled urban cooperative banks in India. Okay. Next, we move on to structure of capital market. Normally, financial markets are divided into two: capital market, money market. Okay. Structure of capital market. The previous section we have discussed about the money market, which provide short-term fund to investors or less than 1 year. However, business unit and investors need fund for longer durations, also for undertaking business expansion or modernizing the technology upgradation, and in this regard, they approach the capital market. The capital market is a market for long-term securities or financial instruments having a maturity period of more than 1 year. Capital market is a market for long-term security or financial instruments having a maturity period of more than 1 year. Capital market are important for channelizing savings, capital formation, and industrial growth. The capital market is a financial marketplace where long-term investments are bought and sold. This include things like stock, bond, and other securities. Business and governments use the capital market to raise money for long-term projects such as buildings, new factories, or funding infrastructure improvement. Investors use capital market to grow their wealth by buying and selling this investment. The capital market is a financial marketplace where long-term investments are bought and sold. These include things like stock, bond, and other securities. Uh, Normally, capital market is again divided into four markets: instruments, intermediaries, regulator. Market, instruments, intermediaries, regulator. Market is again further divided into two: primary market, secondary market. Regulator is regulatory authorities, Securities Exchange Board of India. Then capital market. Capital market comprises of two markets. One is primary market, another one secondary market. The primary market is also known as the new issue market, where the issuer of securities sell the new security to the investors directly without any intermediaries. Whenever the securities are offered for sale for the first time by the companies, they are called initial public offering, IPO, initial public offering. IPO, initial public offering is used to raise capital for funding purpose. Both the companies and government raise funding by the sale of new stock in the primary market. The secondary market is also known as stock market. It is a place where shares, bond, options, etc., which are sold earlier or sold and purchased. In India, you must have heard about Bombay Stock Exchange, National Stock Exchange. They are some of the example of stock exchanges. Secondary market can be either on action market or over the counter. In the action market, trading of securities is done through stock exchange. In over the exchange counter, the trading is conducted without using the platform of stock exchanges. It's not does not have any physical location, and trading is done electronically. The secondary market is regulated by Bombay Stock Exchange, Securities Exchange Board of India. Example is Bombay Stock Exchange, National Stock Exchange. There are some stock exchanges. Then secondary market can be done auction market. Next on financial instruments. Some of the major financial instruments used in capital market. First one, shares. Some of the major financial instruments used in capital market: share, bond, debenture, capital market intermediaries, merchant bank, underwriters, etc. First one, shares. A share indicates a unit of ownership by the buyer of shares, called shareholders or holders of the company. A shareholder has ownership in the company and has voting rights and share the company profit or loss. The company have the ownership. The shareholders has ownership in the company and has voting rights and shares the company profit or loss. The benefits which a shareholders received out of company profit is called dividend. Let us understand it with an example. Assume that there is a company, XYZ limited need fund, rupees 100 crore. For further expansion, for raising this fund, the company will go to the public. The capital of rupees 100 crore is divided into 10 lakh shares of 1000 per share. Now assume that there are two investors, A and B. They want to invest in this company, so they will buy some shares. Investors A buy 500 shares and investors B buy 800 shares. So they are investing 55 lakhs and 8 lakhs in this company, have become the shareholders and will share the profit or loss of the company in the proportion of to holding shares. For the shares are two types, namely equity share and preference share. Next one, bond. Bond are issued by state and central government companies and you raise money for a variety of projects and activities. It is fixed income security and essentially a loan agreement between bond issuer and investors. The bond holder, unlike shareholders, do not have any ownership of the company or having voting rights. There are a debt instrument which is entitled to borrow the fund for the period of time at the varied interest rate. Next one, debentures. Debentures also a type of debt instrument which is issued by companies for raising fund, and investors buy debentures based on reputation and the credit worthiness of the issuer. The interest rate on debenture is higher than that of bonds. The debentures holders have didn't have voting rights. Next one, capital intermediaries, capital market intermediaries. First one, merchant bankers, underwriters, portfolio managers or portfolio management services, stock brokers, regulator of the capital market, Securities Exchange Board of India. First one, merchant bankers. Merchant bankers are intermediaries between the investors and the company. They act as advisors who advise the entrepreneurs from the stage of consumption of the project till production begin. Securities Exchange Board of India has defined merchant bankers as any person who is engaged in the business of issue management, either by arranging for buying, selling, or subscribing to securities, or acting as merger consultant, or rendering corporate advisory services in relation to such issue management. Next one, underwriter. When a company decides to go public to raise fund, all of its securities may be not fully subscribed by the public. So there is a need for someone who can subscribe to those securities. This work is done by underwriter. He agrees with the issuer company that in the case of securities that are not subscribed, then the underwriter would subscribe to the securities itself or by others of the unsubscribed securities. He is paid a fee called underwriting commissions. He is paid a fee called underwriting commissions for this job. Underwriters can be both institutional or non-institutional, institution IDBI, UTA, etc. All the underwriters need to be registered with Securities Exchange Board of India. All the underwriters need to be registered with the Securities Exchange Board of India. Third one, portfolio managers, portfolio management services. Portfolio management, the professional who enter into contract and with the client to advise or direct or undertake investment decisions on behalf of the client. Portfolio managers are the two type: discretionary portfolio manager and non-discretionary portfolio managers. When the portfolio managers manage the fund of the client independently according to the need of the client, they are called independent portfolio manager. Next one, stock brokers. Stock brokers is an individual or firm which is an intermediary between an investors and the securities exchange. The stock brokers trade in the stock exchange on the behalf of their client. In return on their services, they are paid commission on fee. They handle all the paperwork and maintain record of all the transactions, manages their client portfolio, and advise the investors on formulating different investment strategies in the dynamic world of financial market. All stockbrokers are registered with the Securities Exchange Board of India. All the stockbrokers are registered with the Securities Exchange Board of India. Next one, regulator of the capital market. Regulator of the capital market. In India, capital market is regulated by Securities and Exchange Board of India. SEBI was established in 1988 as a non-statutory body, but with the passing of SEBI Act 1992, it was accorded statutory power. The major objectives of SEBI are protect the interest of investors and development and regulation of stock exchanges to prevent malpractices and to regulate and develop a code of conduct for intermediaries such as brokers, underwriters, etc. SEBI perform various functions like registration of stock exchanges, mutual fund, underwriters, brokers, and stock brokers. The stock exchanges and various intermediaries prohibit unfair trade practice relating to the securities market and insiders of trading. These are the capital intermediaries: merchant bankers, underwriter, portfolio managers or portfolio management services, stock brokers, a regulator of capital market. Next, we move on to industrial policy framework. Industry policy framework. The industry policy reformations started industrial 1995. It was influenced by three factors. Normally, the industrial development is aimed to achieve economic prosperity and improving the lives of its people. India left no stone unturned brace of strengthen its industrial development, for which the quest started the independence is 1947. The industrial policy, Indian economy was being built into a self-reliant and self-sustained unit with an aim to achieve industry-led growth. The policy environment lived on import substitution, inward growth, and subsidization. Public sector in India soon witnessed expansion and economic property. The reformation started after 1995 was influenced by three factors. One is young entrepreneurs enter a competitive economy. Second, on tariff rate started dropping down along with quantitative import restriction becoming history. Then multinational companies started entering India in greater numbers and created a competitive landscape from within. Three factors influence. One is young entrepreneurs entered a competitive economy. Then tariff rates started dropping down along with quantitative import restriction becoming history. Multinational corporations started entering India in greater numbers and created a competitive landscape from this. These factors, there are heartful of other aspects that affected the industrial policy, thereby impacting instrument and production. Some of these were industrial licensing policy, control of monopolies, and economic concentrations, policies regarding technology import, along with financial and non-financial policies. Fiscal policies affecting the provisions of industrial finance, development of capital market, as well as fiscal incentives. And stages of industrial policy prior 1991 to 1991. Industrial policy, the model of development and growth, and the changes with time demand, changes in economy policy, and the need to create institution for successful implementation of policy and to achieve growth. This means involvement of state is essential. Industrial policy and strategy. From the time of second 5 years plan, industry-led growth strategy was adopted, and the strategy was based on industrial policy resolution of 1956. The number of changes had taken place during this time. So the industrial policy and strategy 1956 laid emphasis first on fast-track expansion of heavy machine industry to lay the groundwork for capital goods industry. Second, on involve private sector and make them co-partners. Expand heavy industry base in the public sector. Promote and enhance growth of cottage and small scale industry by establishing large cooperative sector. Then industrial licensing. Industrial licensing form the backbone of state policy. The government initially insisted upon a written permission to an industrial unit, allowing manufacturing of only those goods which were itemized in a permission letter was the important instrument which allowed the state to ensure that manufacturing units. The key objective behind the licensing was the idea to work in unison or an agreement with the industrial policy. The various legislation under these policies are three different acts. One is Industries Development and Regulation Act, IDR, Industrial Development and Regulation Act 1951. Then monopolies and restrictive trade practice. Monopolies and Restrictive Trade Practice Act 1969. Then Foreign Exchange Regulation, FERA, Foreign Exchange Regulation Act 1973. The industrial licensing, one is Industries Development Regulation Act 1951. This was ordinance ensures that all industrial units obtain compulsory certificate of registration and new industrial unit to be recognized as industrial unit only after obtaining a license from the central government. Second one, Monopolies and Restrictive Trade Practices Act 1969. The primary role of this framework was to control and concentration of economy influence and discourage monopolies. It enforced a restriction on the acquisition, transfer of shares by certain corporate bodies, control monopolistic trade practices, and restrict unfair trade practices. Another primary objective was to control monopolistic trade practices by promoting healthy competition. Next one, Foreign Exchange Regulation Act 1973. It was enacted Foreign Exchange Regulation Act 1970. This was enacted to control the acquisition of foreign exchange by holding foreign exchange in any form. Then phases of liberalization. Phases of liberalization. 4 decades after independence, the industrial landscape underwent drastic changes. The industrial policy's initial approach was to safeguard and protect the Indian industry during the initial stage of development and economic fluctuation. But this approach did not allow the industry to expand and adopt. Therefore, for reaching expansion, the initial idea were made. Mid 1970 onwards, during mid 1970, advancement and experimentation with internal trade witnessed liberalization. This decade marked liberalization from control, including an increase in license capacities and erase licensing restriction. Licensing policy underwent constant change on complex features during 1970 and 1980s. Mid of 1918 onwards, to keep check on fiscal, monetary, and trade policies, industrial policies was reoriented and gained a push after mid of 1980. Need for accelerated growth. To meet accelerated growth, the expansion were made as follows. Improvement in import, mean improvement in production, and hence import was given attention. The new industrial policy 1991 was get industrial licensing, industrial licensing policy, foreign investment, foreign industrial licensing policy, and licensing was eliminated for all projects excluding some industries. These industries were primarily those industries which were security and strategic concern. Then foreign investment, a new wave witnessed new features. Some of them are barring a few sensitive sector, automatic approval is available to foreign direct investment in almost all sectors. The industries are classified into group and automatic approval is available for up to 100% in specified industry group. Companies which are involved in export of product majorly foreign equity holding up to 51% will be allowed for easy access to international markets. Next one, foreign technology agreements. Foreign technology agreement in a high priority industries, automatic permission to be given while on a lump sum payment, 2 million, 5% loyalty domestic sales, and 8% of export. Next one, public sector. The new policy was breath of fresh air for public sector. It was specified that public sector investment will be made in strategic area. Public sector was given more freedom in terms of entering in areas not reserved for it. Then MRTP Act this act allowed more freedom in terms of removing pre-entry restriction, prior approval from the government for establishing a new understanding or while getting involved in amalgamations or merging of industrial unit. Next, to move on.
Five more minutes I get. 5 more minutes I get.
Okay. Next, to move on to state-specific industrial policies. State-specific industrial policies. With technology and innovation, India is catching up with its global counterpart while pioneering business models and strategy. The state, the state government has shown immense progress. Policies of state in southern regions are perfect example of how constant compliance policy help the region in developing private enterprise and making investment beneficial while nurturing micro small medium enterprise. This help this unemployment at a drastic rate. State specific industrial policy. Then state-specific industrial policies have focused on simplifications and development of the following area. One is single window clearance, labor regulations, online tax return filing, inspection reform, commercial dispute resolution, availability of land, construction permit, access to informations and transparency, obtaining electricity connection, environment registration, single window clearance, labor regulations, online tax return filing, inspection reforms, commercial dispute resolutions, availability of land, construction permit, access to information and transparency, obtaining electricity connection, environment registrations. Next one, agri-business environment. Agri-business environment. If this process can be witnessed to increase in crop production, productivity, diversifications, and technological development. So witnessed. This process can be witnessed through increase in crop production, productivity, diversifications, and technological development. The trends in agriculture production